You are watching Stockwatch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Zwelakhe Mnguni from Benguela Global Fund Managers and Mark Du Toit from Oyster Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Thank you so much for your time, Mark. It's been quite interesting to see how the different markets have performed this week, and it looks like even with the up and down moves, drastic moves that we have seen, particularly in the US markets, even in Europe, at some point we had record highs. It seems that the JSE has held its own. Does it seem like the JSE is insulated from a lot of the fear and volatility that is going on globally?
Yes, well, our market's quite interesting in that it's got quite a broad structure. So we have South African domestic stocks, we've got dual listed stocks which have offshore earnings. We also have a large component which is precious metals, so PGMs and gold. So if you kind of unpack the year-to-date performance, our market's up about 4%, and a lot of that is the gold sector. Gold shares are up about 50% this year, largely catching up to a gold price which has done very well over the last 18 months.
Well, actually just talking about that gold sector, because it's really been quite interesting looking at the share prices of the miners, and particularly this week we had our eye on Pan-African Resources. Of course, we saw the share taking a knock when it released its trading statement, and then when it released its results the next day or 2 days later. But it seems that even because I was actually asking an analyst about that knock, and he brought it into perspective that actually for the last year it's gone up so much that that knock that it took for those 2 days was really negligible. And I'm wondering at this point, because you usually look at those miners that there is an operational risk, but even when those they don't really perform well operationally, it seems that the share price is still following the gold price. So would you say at this point there's a lot of appetite still, and not really because of the operational side of these miners, but really what's driving investor appetite is that gold price ultimately?
Yes, ultimately, I mean, these are single commodity mines. I mean, they largely just mine the gold. Some of them have a bit of copper that comes out and a bit of silver that comes with it, but they are very dependent on the gold price, and they have no control over that price. So now when prices are high, they're making very good margins, great cash flows. And it's interesting to see what the different mining houses do with that cash. So some of them have plowed that cash back into further or future growth opportunities. I mean, last year we saw Gold Fields buying a Canadian windfall opportunity to expand there. Anglo Gold, it's got quite nice opportunities in America now, and last year it also bought an Egyptian mine. Pan has bought into a Australian junior mining venture. So Pan, which has always been a South African business, is now venturing also into Australia. And also Harmony's also took a stake in an Australian venture. So the mines, they make money, and then they find opportunities to build new mines. And along the way, you get a reasonable dividend yield. And if the gold price goes up, these are very geared plays, and they go up quite a lot with it.
And just lastly on gold, I mean, we've had a lot of investors even on Stockwatch saying that they want to short their gold exposure or take some profits off the table. But would you say that the environment is still supportive of robust buying activity?
Yeah, I mean, it's certainly a difficult call to short a gold share. They're very volatile, and I think what we've seen over the last few years is this change where central banks around the world, particularly post the Russia-Ukraine war, central banks around the world have decided to hold more gold as a store of value. It is a diversifier away from holding US dollar denominated debt. And from China to Kazakhstan to Turkey, um, many central banks have actually started to increase their holdings in gold, which has just added extra demand for the metal. In the very the last month, I mean, we have seen a bit of an interesting disconnect whereby US buyers are looking to onshore physical gold. So there is a worry that perhaps these tariffs are extended to physical gold. It doesn't make sense to me that that would be the case,
Yeah.
but it is a possibility. And so we've seen additional demand for gold for people wanting to onshore the metal into America. And that perhaps goes away post 1 April when the actual tariffs are announced. But yeah, there's a lot of demand for gold, and it's difficult to see anything that will really make make this demand dissipate at this point.
Well, talking about gold and a store of value, we find a lot of that in luxury goods. Luxury jewelry maker Richemont. There's a question here. Is Richemont a buy? It keeps going up every day. HSBC also upgraded it today to over 4,000 a share. That gives it still plenty upside on the stock. Yeah. Would you still see a significant upside in Richemont?
Well, Richemont is a fantastic business. It is a business that you want to own at a reasonable price. They came out with a fantastic update in December, which was really, or on their latest quarter, which was really a surprise to the market. Their peers in the luxury space came out with weaker updates, and Richemont came out with a really strong update, so bucking the trend. It was particularly strong in hard luxury, so their jewelry, and also particularly strong in the US consumer space. I do think that perhaps it has run very hard, and I think that there will be an opportunity to buy it at a better price later. But if you're an investor who wants to hold it for a long term, for a 10-year view, then your entry price is it's less of an issue if you buy it today or in 6 months' time. If you're going to hold it for 10 years, the compounding effect you'll still do well out of it.
All right. Well, let us go to the lower end of the market. There's a question on Boxer. Of course, low income consumer counter. Can you ask the panel, we don't have a panel. We just have you, Mark. I don't know where Zwelakhe is. But is it still a good time to accumulate Boxer for the long term? 5 years at the current price level and under 70 Rand a share. I know that it had actually gone up quite a lot after it listed. Yeah, would you still be? I know that this is a very good quality company. A lot of people were excited when Pick n Pay listed it at this price. Though, would you still be finding opportunity to buy it?
Yes, we still like Boxer. It is a company one of the few companies in South Africa which has a good growth trajectory ahead of it. They want to double the number of stores that they have. And in that, I mean, they are really taking or tapping into the market, which is underserved at this point. So there's still a lot of runway for growth. And below 70 Rand a share, I think you can still own it. And with all growth stocks, I mean, there are bumps along the way. If they miss their guidance, the share could be under pressure for a short term. But the great thing is, companies that are growing tend to it's a short-term aberration, and then as they continue to grow, their share price eventually recovers back. So there's a bit of safety in owning a growth stock, and we think that there's still a lot of runway for Boxer.
Well, also some sort of safety for Pick n Pay, looking at the fact that they still have significant exposure in the company. And actually, I do need to go to Pick n Pay because all of us have been talking about its new ad with rapper Rick Ross and a comedian Schalk Burger. But really, the talk has been around them getting Rick Ross. Quite a lot of different opinions on it. But besides the ad, let's talk about growth trajectory and strategy. It seems that, for the last few months, there has been some interest and some buying activity on Pick n Pay. I think also in their last trading update, things seemed to be improving. Do you think it's worth for Pick n Pay to be on someone's radar at this point?
Yeah, so well, with the listing of Boxer, you can now take the Pick n Pay's holdings of Boxer and you can work out how much that's worth. And then you're paying a lot less for the rest of the Pick n Pay business. So it's kind of de-risked your investment to some extent. Pick n Pay are in a difficult space. I mean, they have stiff competition from Shoprite, and Shoprite is investing further in price, making it difficult for Pick n Pay to compete. So it's a turnaround story. They had a high cost base, which numerous CEOs have tried to rectify, but I think that they do have a lot better, well, they have a better chance now, and the fact that they have Boxer as an asset, which if they need to, they could sell down further. So it gives them optionality as well. So yeah, I think that it is a lot stronger investment case than it has been in the past.
All right. Mark, there's a question here on BAT. Of course, we saw it posting its results today. The comment from the viewer goes, not great, but not too bad. Was the share down on news from Canada lawsuits, or are there other reasons? I think there's just lots of, regulatory things that they are dealing with. They spoke about regulatory headwinds in Bangladesh and Australia in relation to the combustibles division. But also, they're also facing regulatory scrutiny over the vapes as well. Is this going to be a long road for BAT, Mark?
Yes, it certainly is a long road. So the update today, it was largely in line. I guess the market was maybe a little bit disappointed with the outlook statement saying expecting growth of 1.5% to 2.5%, given that they also have a currency headwind. So there's a lot going on in BTR, but ultimately they're trying to move, or they are moving away from their smoking cigarette product. We know that's a product that's being targeted around the world. You get sin taxes, you get legislation against you, and they're moving towards their new category products, which are smokeless products. The CEO today is saying that by 2035 they want to have no more smoking products, just be smokeless products. And in fact, I think 17% of their business now is the new category product. So they are making headway, moving away from the smoking product. And paying down debt. They're hugely cash generative. So they're able to pay down debt. They're doing share buybacks, dividends. But I guess the investment case would really be that they are able to move to those new generation or new category products quickly. Philip Morris is ahead of them. I think Philip Morris is at 40% of their business is now new category products, so ahead of BTI. And BTI's got a big business in the US, and so that's when it was the Democrats in charge, there was a lot of focus on banning menthol. The Republicans are less worried about it. People their attitude's more like if people want to smoke cigarettes, they can. So I think it's just a long road ahead, and it all depends on whether they can move to those new category products as fast as they want to and continue to pay down their debt.
I always chuckle when they say that they want to create a smokeless world. Have you seen those big vapes? They just fill up the room with a big cloud. Yeah. Zwelakhe, you can catch the smoke. BAT coming out with the results today, and the market not impressed. The stock was down, I think, over 9% at some point. They're still giving out dividends and still buying back shares, still trying to add value to investors. But are investors maybe thinking that some of the headwinds are maybe overpowering the good things that they are doing to add value to investors?
Yeah, hi. I think the one thing was the guidance was a bit disappointing, but I think overall as a business, I mean, it's a slow grind. 3.6% growth in earnings, and your dividends are going to grow more or less in line with that over time. They're sitting on debt that they acquired when they bought Reynolds, and that's a painful process. They've got a lot of work to do. The new generation products, I think they said they grew about 20 to 25%. I think that's positive. But as Mark said, it's a small percentage of their portfolio at this stage, and they need to accelerate that. They did talk about moving to the premium elements of that
Yeah.
new generation products, but it will take time to build that market up to be able to make it a meaningful business.
Well, let's go to Super Group. Um, It says, so I actually see that this was sent on the 5th of February. I don't know if it was answered or not, but let's get to it. Am I correct in my analysis that Super Group is currently a no buy simply because the post divvy price will drop by the 16 Rand 30 divvy proposed unless one is going in long term and consider it a quality company that will grow again. There's been quite a lot of talk on Super Group, particularly after the sale of that the Australian business. Mark, no buy though?
Well, I mean, I think that there is a kind of a special opportunity in Super Group. So yes, you are going to get your big dividend now, the distribution of the proceeds from the sale of SG Fleet, and then you're left with a business that that we think will probably be either taken out by management or perhaps taken out by another player because it will be quite small, sort of bite size, and I think that Peter Mountford's also been there a very long time, and he probably doesn't want to try and rebuild the business again. So yeah, I think that the business will ultimately be sold and delisted in some form. And if that happens in the next year, then I think that you actually will make a fair return. I guess the trap is that you sit in a company that that doesn't have obvious growth prospects, and maybe it just sits there and is ignored for longer than you would like. But I think on the sum of its parts, I think and if it gets taken out within a year, I think you actually will do quite well.
Yeah. Your thoughts on Super Group and its growth trajectory? I remember actually even in their last results, they didn't look excellent. But would you still be finding value there, Zwelakhe, or not?
Yeah, first of all, I mean, just addressing the sale of that SG Fleet. I think it was a good decision. I mean, that business was like hanging like an albatross on their necks, in that it was low return, high debt kind of business. So they did well to get that rid of that. The rest of the business that is left is actually not a bad business at all. It's got some niches in the area like coal supply chain. And I think it's probably we will see improved performance from that business, unless, of course, we end up with a Transnet that's got its act together properly to actually take market share back from the trucking companies. But I think at this stage, if I look at what they dropped off versus what's left, I think what's left is a little better business than the previous one.
All right. Before we get to your stock picks, gents, there's a question here. Your view for investing in China's CSI 300 for the next 5 years. Interesting things that are happening in China. I know that the market is seen as quite cheap. Lots of things happening in the AI space. Also saw, for example, yesterday Alibaba partnering with Apple, and that stock finding favor. Just a broader CSI 300 sector there, Mark?
Yes, well, I think that we have seen a very large divergence between US listed companies and Chinese listed companies. The US tech companies have done phenomenally well. I think that China perhaps, I think it was during COVID where they decided that they were no longer in favor of online after school learning companies, and basically with the stroke of a pen just destroyed a whole industry. And that really spooked a lot of investors because there's no real protection for your business there. In America, you can take the government to court. There is all sorts of sort of Chapter 9 institutions that you can use to try and protect your business. But in China, those things don't exist. Whatever the Chinese government decides goes. So Chinese stocks should actually trade on a lower multiple than US stocks. But having said that, the gap is very wide at this time. And now that we're seeing this kind of trade war escalate, one of the things that countries can do is to target US tech. We see France has a 3% digital tax payable on online sales. So if you think of things like we all buy Microsoft products, we all buy Google, AdWords, Facebook. I mean, countries can actually start looking at the difference in the trade from a services level and not just the goods level, and target these companies from a tax point of view. So I think from that, just having said that, I think that the US tech, has had a very good run, is on a high multiple, and I think that if there's a bit of a headwind from potentially a tax point of view, then you'll see the money flow into Chinese tech, which is a lot cheaper, and hasn't had the run that US stocks have had. So yes, I actually quite like that idea.
Okay, I mean, I know that there is risk in the Chinese market, Zwelakhe, but is it just too cheap to ignore? Your thoughts just on that CSI 300 instrument?
I agree with Mark on some of the points. I mean, I've actually been banned in China, and I don't believe that the discount is wide enough for us to go in. I think that there are probably three things that I could highlight. I think the one is the regulatory risk that is done in a very haphazard way, not consultative. The second thing is that even in sectors like tech, the ability of these companies to export their technology has been contaminated by the propaganda that's running around the world about China's technology companies are actually, they've embedded the military, the national military into their products. Therefore, you interacting with their technology, you're actually interacting with the Chinese government in a way, and your data has been stolen. I think the last thing is, if you look at sectors like staples and even healthcare, again, your ability to extract pricing there as a company is very difficult because they run on different principles. They collective prosperity, I think that's what they call it, and you won't be able to see staples perform the way they perform in the rest of the world. So I'd be extremely cautious. I'd want a bigger discount for China.
All right. Well, stocks that you are not cautious on. Your stock picks for today, Mark.
Yes, so I'm picking Investec tonight. I think the management team have done a very good job. Fani Titi, the CEO, took over from Stephen Kosov. They have done like a mini restructure of the business, sold down the N91 stake, sold down their stake in the property group, now called Burstone, and really refocused on their core business, which is banking and wealth products. In South Africa, they've looking to grow their customer base, adding in IT professionals into their professional target market. They're looking to double the number of accounts that they have. They've got a new business banking product that they've launched. So really there is some nice growth opportunity in South Africa. And the UK business is also, it's in a difficult macro environment. So the UK environment is looking quite tough at this point, but they have a very niche business, about 8,000 high net worth individuals there. And then also did the deal with Rathbones, which was to take their wealth business and to merge it in with Rathbones for a 41% ownership. So I think that the group is actually refocused and well placed to grow earnings sort of 5 to 10% a year. You get a 6% dividend. And I think if they continue to deliver on their promise and on their guidance, that the stock will actually re-rate in line with the other banks. So you'll get a bit of a re-rating as well. So perhaps an 18% return.
All right. What are you banking on today, Zwelakhe?
I'm taking Salesforce, the American company CRM business. The business has seen some slowdown in terms of their growth. I mean, it used to be very high growth, and it's dropped to around 10% growth. I think the one thing that's been positive is that the margins have been improving. So as they're getting more efficient at operating their business, I think the valuation is not demanding at 26 times free cash flows. But also, I think there's potential for them as we move to a world where the activities in sales are being dehumanized through AI. You could find that the analytics in the CRM space might be helpful in that space. So I think that it might have slowed down from a growth point of view, but I think it's a dominant player that's got credibility that should be able to extract the value out of the market.
All right. Well, thank you so much for your time and for your analysis today, gents. To our viewers, if you have sent questions today, not to worry. I will be tackling them with my analysts tomorrow. I'm always here. So we have questions for HCI, Trenco, Blue Label Telecoms, Banks and Hauser-Busch InBev, and Bell Equipment. We'll get to those tomorrow. And please do continue to send your questions. The show is live at 12:30 tomorrow afternoon. That is all for tonight's Stock Watch, though, thanks to our guests Zwelakhe Mnguni from Benguela Global Fund Managers and Mark Du Toit from Oyster Investments. Yes, as I said, pre-recorded tomorrow. No, it's actually not, is it? Yes, it's pre-recorded tomorrow at 12:30. So please be sure to send your questions in the morning to stockwatch@bdtv.co.za via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Up next, the close. Stay watching. Thank you.